Hi everyone. Before starting, I just wanted to gauge a bit the audience and to know who is currently trading the crypto markets. Okay, let's say about half. And who is interested into starting trading crypto markets? Who is obviously not trading yet? Okay, great. So, as a first question, also to answer a bit to the talk that we just heard, where we're speaking about holding versus trading, I just wanted to have each of you your opinion about this. Like, obviously here we speak about trading, so why for you it's better to trade rather than to buy and hold?
I would say here that there is this misconception that trading is something you can do on the side. For most people, they have to understand that trading is a full-time job, and they have to have a certain skill. It's not just picking, so to say, pristine assets that in crypto don't return any revenue and don't generate any revenue outside of Ethereum. So people who just try to trade and consider trading as something they can do in their free time as a hobby, they wouldn't succeed. I think that's the greatest misconception and the greatest trap that something in crypto or in investing can actually fall into.
So for most people who doesn't have time, buy and hold will be better, but for people who wants to be serious about it, trading could be...
Yes, or that there would be some cases where you can buy something and hold it and combine it with other trading products that are fully passive, fully automatic, next-gen trading products and services that actually connect those two pieces together so you can have the best of both worlds, basically.
For me, I never trade. I work at a trading company and I would never dare trade. When you work in institutions, you kind of see the other players, you see what it takes to be a profitable trading company, and it's enormous amounts of work. And yeah, just think about it. What kind of companies you will be trading against? Because on every trade there is somebody on the opposite side. And there is a poker saying, if you don't know who the idiot on the table is, you are the idiot. So yeah, be vigilant and be very, very careful. I personally wouldn't do it.
On my side, I would say that it essentially links to who you are as a person or your status at the moment that you decide what to do. If you have sufficient money, like a lot of money, you probably will decide to stay on the side and do the long-term investing and not bother investing on a daily basis or just day trading or swing trading. Whereas if you want to build an income for yourself, you will be more tempted to go into the trenches, so to say. So it's either it has already been decided for you in one way, or it's more of a psychological need that you need to be up there and fight with the trend and to learn and to show that you are able to do it. So it's pretty simple if you are to decide about this. You analyze your situation currently and you see what you can do. And as mentioned, I agree that it cannot really succeed as a hobby. You have to give it your all, or you just maybe realize that you just want to have fun with it, like going to a casino maybe, and you will just maybe have some additional, sparks in your life, or some additional money or not at the end of the day. But it's pretty much decided from the beginning what type of investor you should be. That's my point.
And how can you know yourself before trying?
Well, you will look inside your pocket. Do I have a lot of money? I will go the long way and I will keep it light. I will make the money, no problem. But if I'm trying to build some sort of little wealth for me, you probably will be more tempted to go inside and fight for that, because you cannot really wait until the trend comes your way or until you make, let's say, the 200% of your portfolio in 6 months, when you believe you'll be able to do it on a shorter term.
Okay, we can dig about it after, like also psychology or risk. But before, maybe it's good if, because you all trade in a different way, so can you just give a quick, like 1 minute or 1 minute and a half explanation of your way of trading? But more interestingly, why do you trade this way and another way?
So I can continue. I've seen for myself that I cannot go the professional route. I simply cannot. So I've decided to stick to a few swing trades a month, leave it open for a couple days, or if I want to have fun, I will just try scalping. This works the best for me. I've had, trial and error a couple times. I've seen it. I don't want it anymore because it will just, it will start to backfire against you if you don't meet your right style of trading. So yeah, I try to keep it on a minimum, and it's also, that principle, like the more you trade, the more you do it against yourself. Try to find the right entries for a couple trades, let them run. If they go against you, cut them, but if they go your run, let them play out, and you will have sufficient money, and you will make more money from 4 trades than you'd have made from 25 probably.
And what do you use for entry point, or what do you use some tools, or your feelings?
With the tools, I've also sort of given up because the assets that I trade are ones with generally sufficient liquidity to not impact or to not require an extremely fast decision. So anything that you have, for example, on Binance or you have on OKX or on Bybit that you're able to add some leverage to it, you can do 2x or 3x leverage, and you can have a decent retracement analysis, or you can time it up with some news or with following the trade, and the trend I meant, sorry, and you will be able to make some money for yourself. Like you'll be able to, to check a bit every time you do it, and you'll be able to be profitable on the long run if you just keep it on the low. For tools, I just, news, CoinMarketCap, some charts, daily, hourly, and 30 minutes, depending on how much I want to let it run. And at times, I try to temper myself and just to wait for a retracement back on a lower point.
So I trade only with algorithms, 100% automatically, because of what Blagoje said in the previous talk. Market has changed in that way that rallies and increases in prices is short-lived. There are plenty of instruments and plenty of new coins being brought up as we speak, gaining attention these weeks. It's Aster. A few months afterwards will be something else that happens when you sleep, so you don't have the time to look at the chart, to place the trade. The declines happen very quickly, so price only stays for a couple of days at elevated points. So basically, this is the perfect area for algos, for algorithmic trading, for fully systematic approach, because it removes all of your emotions and it relies on mathematical models that have worked in the past and have high probability of working now too. So basically, what I'm not very fond of with people who have these theses for only long-term investing is that they should realize there are a lot of hobby players, casino-minded people in crypto. Those are players that algos play against. Those are the food for algos and for what we do. And I believe that the sophisticated investor in crypto would be and would have to be a person who has the mindset of an allocator, meaning you don't need to pick the certain assets to be successful. You can structure a portfolio in crypto with both holding assets and picking the right instruments, for example, algorithmic systems, funds, etc., that can be stacked together, because crypto is financial Lego, and this is something we can do. I mean, you can have your Bitcoin, we can trade on top of it with algorithms. You can stack those returns the way it is stacked with DeFi, with staked Ether that is looped, etc., etc. So basically, this is what the sophisticated investor can learn to do. This is what I do and what we try to offer to a lot of people. and I believe this is the future, and this is where most returns will be made in the future. Not just buy and hold, not just hobby trading, but combining both those approaches in a more professional way by using professional services.
And how long did it take you to build those algorithms? I mean, there was
Well,
a lot
it's been a 20-year-old journey.
So you use your knowledge from the traditional markets into
Yes,
crypto?
basically I've been on the market since 2006. So I've been in crypto since 2013, and ever since 2017, 2018, it started with the perpetual futures, with the derivatives markets, where the largest volume is now being done. In crypto, it is something that actually has evolved and is now suitable for algorithmic trading in general. So trading tech has advanced quite a lot, and that's why it's very fruitful for a lot of people to take advantage of these casino-minded people. And
can you just quickly explain briefly, like your algorithms, how do they trade? Like, is it following the trend or some specific?
Yeah, so we have mostly two types of algorithms. One are those that try to capture momentum when price increases very quickly or declines very quickly. So those are the momentum expansion, the volatility expansion points in the market. The other types are the mean reversion ones, where think of it as buying the dips or selling the rips when an asset is in a bull market or in a bear market. So basically those are very used approaches in traditional markets. There is a lot of scientific research about those models that are being transferred between different asset classes, from commodities to stocks to ETFs to indices, now crypto too. And crypto is the perfect soil for this, because there is a lot of volatility, a lot of stuff that can be taken advantage of those type of systems. So basically it's a portfolio of different approaches that tend to work well when combined in a team.
Do you know what did they do today, your algorithm?
Yes, today we are up. Yeah, today we are up.
So you short the...
Yeah, we are 2% up. That's what
Okay.
we were joking, that we don't just try to just place trades, etc. So it works 100% automatically and works in both directions.
Dany?
Yeah, to continue on this kind of what trading companies and how they make profit, for us as well, we are a market maker. We are neutral. We don't take long or short positions. But yes, volatility is amazing. From one side, you see these opportunities because when you do high frequency trading, you usually have the infrastructure that it takes to offer that service, to offer market making. Is extremely fast, and those moments of chaos when everything starts breaking apart, exchanges slow down, you know, nobody really knows the price of the asset, you can make a lot of money. So yeah, this is how we trade at Raven. We're a market maker, and absolutely automatically, systematically, it's almost no user input. Of course, there are some configurations and around that, but yeah, the crypto market is great. And I have a question, actually, if there are companies that offer these products for, let's say, retail investors that they would like to use these strategies, why wouldn't the companies themselves deploy these strategies and gain all the profits from themselves?
Yes, because most of the companies in crypto, we have institutional clients too. The thing is that most people in crypto, they either want zero risk, like only focused on the yield side. That's why there are a lot of people in DeFi. They want the perception that their collateral doesn't go down. And there are the other type of crypto investors who want to capitalize on insider information, on front-running everybody, like VCs, and trying to dump everybody. So it's basically a competition between strategies, which one has the most advantages for the given investor. So basically, there are funds of funds which invest in us and try to diversify their approach that they have with arbitrages, with VC rounds that they have invested. But for most people, they have a certain approach. They are doing, they're investing, and they have their bias, to say the least. I mean, a person who has done arbitrage and market making all its life would have difficulty seeing and experiencing volatility in its portfolio of, let's say, 20–25%. It's just a mental, psychological thing that you have to adapt yourself to, and not everybody is willing to, yeah.
And just for market making, so you both do market making, but in different ways. You it's for trading, you it's for helping liquidity. Can you just explain quickly to people what is market making? Because it sounds like a big word, but maybe nobody knows what it actually is about.
Well, market making, yeah, it's been around since electronic trading. So your 80s, 90s, the moment the exchanges moved to electronic trading, and it's basically providing liquidity in the order book. You place your orders, and you hope to God that you're not getting hit by somebody with a proprietary strategy that is smarter than you, has a more kind of forward-looking pricing, perhaps. And yeah, it's picking up pennies in front of a steamroller, basically. And yeah, there are two, I think, major distinguished, market-making companies. One of them are your Optiver, Jane Street, SIDSEC, that really focus on trading, make a lot of money from trading. And also on top of that, you have your strictly business deals with exchanges, with token listings, and other kind of income streams.
How can you make money by providing liquidity?
Oh yeah, one of the main things is the spread. So you're quoting a spread. There is this, I think, misconception that you kind of know the price and you're quoting around the price. What's really important for market making is that you get, even flow on both sides, on both sell and buy. And the more venues you trade, obviously, that becomes easier. But the essence of it is your spread, and of course the arbitrage opportunities happen during high volatility. So everybody's panicking, you have the fastest infrastructure, and you just snipe very good deals on a very good price. And yeah, as long as you find a way to hedge it as fast as possible, you realize immediately the gain. And this is why most market makers, when they look at their NAV, it's a slow up. It goes slowly up to the right, and it's very nice. And as you mentioned, we don't have these drawdowns. I don't know what's going to happen if we see a 10% drawdown in our net asset value. But yeah, this is why we are market neutral.
So if I understand, you both sell and buy at the same time to other participant of the market who wants to buy or sell. You are the counterparty, and you hope that you do it at the same time, so you are not exposed to the movement.
No, of course, this would be, perfect hedging, instantly hedging. And when you do that, you pay a lot to hedge. Usually what happens is if your pricing model is good, the flow will hit you automatically on a roughly balanced. So at any point, if you're not fucking up, you can see just as much buy volume as sell volume, and you'll be roughly neutral. Of course, that doesn't always happen. As a market maker, you are fundamentally against the market. When the market starts moving in a way, you are there to provide liquidity. You are the liquidity. So very often you would find yourself on the wrong side of the move. So then how you manage your risk, how fast you decide to hedge in different situations is extremely important. And this risk management is what keeps you alive and doesn't kill you from just positional losses.
And you at Vortex, it's different kind of market making.
At Vortex, we focus on one way of market making, which is using the client's funds entirely, not deploying the stablecoins ourselves. And this one transits to making money if the client makes money, and if the normal trader makes money. For example, if the price is rising due to some performance from the company, due to the news, due to the trend, we will also make money, and the client will also make money because we will be able to liquidate a bit of that when we are deploying the liquidity on the other side, on the seller side. So as market maker, ideally you make the road and the trading experience fairer for everybody. So they are, insured against bad actors and stuff like that. Now there's also another model of market making, which is the loan model, in which you deploy your own funds and you get the loan from the client in the tokens. So this is one of the more riskier sides of market making, and the one which is usually hated but also loved by the community, because this is the one that people believe that makes and pumps the prices. What it means is essentially that you get their tokens at a certain value, but you are required to return them just in their essence, not in the value. So for example, you get the tokens worth 10 million, but you can return them at 500,000. You've executed your mandate and it's totally fine. Where that money has gone, well, who knows? Maybe you dumped, maybe you didn't. This is one of the more riskier sides. But market makers in general, they work under imperative and explicit mandates, both from their client and also with the law. So it's extremely difficult for them to do something bad and to not be repercussions. Now, if we go into the bigger players, of course, as in any business, if we're talking billions and hundreds of millions, everything becomes a fee. So they can play however they want. If they want to play, with their reputation and stuff like that. If they abide, just to pay a fee, a settlement, 5, 10 million, some of them maybe will go to such risks and, trade against the interests of the client. But whereas this, is out of the question, and we have a separate model to that, which, does not allow us.
Okay. So you trade, all of you, differently. If someone wants to trade the same way that you do, where should they trade? Like, where is the best liquidity, security, and so on? And what journey should they take on? Like, if they want to trade the way you trade, so to build algorithm, what do they have to do? What do they have to learn? So
basically, the first rule that one should follow is to know to know thyself, as they put it. So they should know what are they very interested in. So if they have quantitative approach to markets, so if they like numbers and probabilities and they want to have this approach applied to the markets, then definitely algorithms are for them. But unless they want to take this road, then they can start looking at services or products that utilize those algorithms. That's what we offer. We work with Binance, we work with Bybit, where there are the largest, deepest markets in terms of crypto futures, because those are the markets that attract the most volume, not spot, and they attract the casino-minded people, so they attract a lot of the fish in the pond, to say the least. And yes, every trader should look for inefficiencies. So market making, all those mathematical models, they're looking to those inefficiencies between the bid and the ask, and that's what they want to capitalize without taking much risk. Every trader should define the amount of risk they're willing to take and should find a model that utilizes this amount of risk they're willing to take in order to find the best risk-adjusted return for this amount of risk. And then, yeah, they should find the best way to do it. Some are choosing the manual path, and with time I see less and less people trying to go the manual path, like manually trading financial markets, but there are still some. So to wrap it up, I think people should just dig deep and think what they want out of markets. how much risk they want, what is the approach that they would like to use, and if at some point they see that something is not like what they expect, they should try to see whether or not they can combine it with some professional products or services.
But you are on the market for 20 years. Someone who just starts, they can't do what you do. So
yes, of course.
What you would...
Of course, I mean, it's a learning curve. Yeah, definitely a learning curve. But it's not a very steep learning curve. So the steepest learning curve is in the psychology. Because 20 years is not just about the skill of learning how to code, how to structure a system. Actually, most of my systems are like, one system is like 10, 15 lines of code. So nothing complex. But just trying to have the patience to sit this out, to know what you have to do in hardship times, etc., is something that you learn with time and only with time. So basically, if you want to become a trader, you should start working on your patience.
And should you become a trader because you want to make money or because you like trading? And...
Well, both.
But if it's only for money, can you become successful?
Yeah, you can do. You can definitely do, but it will be harder for you when hard times come by. Yeah.
So if someone wants to do market making the way you do, is it accessible for anyone, or you really need a structure like you do, like all those robots? And
oh man, there is so
where
much.
do you do it actually also?
There is so much infrastructure required in order to do this without getting absolutely it. And it's the markets are a shark tank, and it's extremely difficult. Obviously, new market makers are coming out. Our company is, a startup. We are 15 people. We are competing with the biggest names, so it's not impossible in any stretch of the imagination. But my advice would be, if you want to do this, it's a good way of making money, sure, but it's a very special kind of job. It takes a certain type of person to work 60 hours a week, and when the times get bad, to keep and push through. And to do that, you need to tap into some very internal drive in order to push through and succeed. So yeah, in my opinion, test it. Check it out. Does it work for you? From my experience, you have to be quantitative in nature. You have to enjoy mathematics. It's going to be very difficult for you to do it in any other way. But yeah, there are a lot of other ways to make money as well. So don't jump into it if you're not sure.
Well, on my side, I say to operate these markets, you just got to prepare your best two assets, I'd say, your mind and your heart. Your heart generally will become harder and harder. It will become like a rock. So you have to prepare to make it soft again. So in terms of being prepared for this, in terms of what to invest, what tool to have, you just have to keep sharpening these two, your brain and your heart, because they will converge in how you play the market, in what profit you are satisfied with. This is the number one problem. When you see you've made in one day $500, in another 1,000, in another 5,000, and then you make only 100, you will go crazy probably. And when you learn to temper that, that's when you've accomplished the first lesson, so to say. So there are more and more lessons like this, and these are the harder ones, not necessarily the technical ones, which we've all done school, we've been through a college, we've had maths, physics, we've done computer science. You can, you can champion that. But the real ones are within you, and these are the ones that will receive most of your time and most of your money. If we are to talk about, some specific tool that you want to have, I don't know. I mean, this is in the traditional market, but I really liked the Bloomberg terminal. It's like $25,000 a year, $2,000 a month. It's genius. It's extremely well to execute transactions. Now, if we're talking to crypto, The more riskier it gets, the more you will need such tools, and these tools, will be required for pairs, ideally with low liquidity. This is the moment where you will have to, to have quick decisions. You will have to have everything prepared with the bots, with the algos. Whereas, in the deep liquidity markets, in the big exchanges, it's pretty much done for you to just have a smooth ride and enjoy it. I wouldn't say you need that much of a preparation initially, but you can add it up later after you've championed a few principles and after you've learned to live with yourself and with how you want to operate the market. After that, you can just automatize it, and you just let it open. You make $50 a day, 100, 200. It goes up, it goes down, you still make money. But the problem is within you. When you probably know that if you have gone more aggressive, you would have made 20 times that money. When you learn to let that go, you will be able to make money, all sides possible.
So the common point, since the beginning of the talk, none of you has spoken about a method or a technique or tools or whatever, but every time when we ask people about trading, they are all asking, oh, how do you trade? Explain me how, show me how. But you don't speak about it, and the people I speak about, I speak with some people about trading, and none of them speak about their method. They all speak about risk and emotions and management of your psychology. Why? I mean, so trading is not about the method. You can trade the way you want, or if you are good in risk management, it's okay, or what is the correct recipe?
Generally, yes. You will be able to make money any way you trade. It's the problem with how you lose it and what you do after you lose it. I mean, even if you don't know about trading, you place 5 trades, you lose 3. In the other 2, you make profit. You make 10 times your bank. What do you do after? I mean, somebody will explain you their method, and you will replicate it, but you will just lose it. And it's the journey with managing, what you get. I mean, you could get the best tools, you could get the best car, you could get a nice Land Rover, and you'd go on the mountain, and you see the guys going over those, abrupt cliffs, and you try to do it yourself, but you don't know exactly how to operate that. And somebody will give you, some lessons, but you have to be with him, you have to see him flip over a couple times, you have to get his heart, his courage to do it again, and to be resistant to the damage he gets inflicted. So, the money will come, like that meme on TikTok, the money will come. You just have to learn how to keep it, how to keep it and how to keep doing it. You will make the money. You will make the money 100%, but you will operate against you most of the times. So that's, it's like a boring point, but it's the real point. It's, general rule of life.
Is it why you went in algo, emotions?
Yes, basically, this is a very, very solid point. So trading, like life, is a continuous process. And it is a process fueled with a lot of uncertainty. So you basically have to try to have a mindset that everything is like thinking in bets, so thinking in probabilities. You have to have a certain approach to your capital so you can save it. And as Valentin pointed out, you have to survive. So this is the first rule of compounding in general. So you survive with a lower drawdown, smaller recovery period for all those losses, etc. So to do this, you have to have the right mindset. You have to not play against yourselves. Because most of the time with trading, you have small wins. You're picking pennies in front of a steamroller. So basically, you may succeed in certain times, but then you make very costly mistakes because several things happen at once, and you keep on making mistakes because one mistake provokes the other, etc., and you overwrite your process, etc. So basically, you have to have the right mindset first, and then you gotta have the right tool set. But the tool set is more with the skills and with the and with the knowledge about how markets work, what doesn't work, that everything is uncertain. So there are a lot of abstract things.
And what does it mean to have the right mindset? Because it's, you know, it's a word, but concretely, what you will advise to someone who can't keep up with their losses, or what should they do if they want to?
Patience, humility, thinking in bets, like thinking calculated risks, and thinking that the largest loss is always expecting you. So it's always expecting you. That's what happened. That's what we've seen with financial history, that all of the great models, all of the great funds, Nobel laureates in economics that have been doing amazingly risk-adjusted returns, like no loss of principal, have collapsed. So basically, you gotta have this very risk management type of approach to life, and to have this humility and patience to overcome those hardships.
Okay.
Yeah.
Quickly, and then we go to questions.
Absolutely. Very quickly to answer how to get started. There are a lot of educational material online. So even in YouTube, there are channels that are quantitative in nature that are going to teach you how to price options, how to, or at least teach you the models and how people approach pricing options. And then what you do is, you very well know these models, you go and you try them. Of course, don't trade with real money, try paper accounts, see what's going on, try to do some simulation. But there are a lot of resources. Martin Lopez, a lot of books, and maybe not, that's maybe not a good recommendation to go into his first books, but you can find a lot of recommendations online on Reddit, etc. Just grab the papers, read them, try to understand them, use LLMs, they're very good, you can give them the whole PDF, you can ask them questions because it's very dense, usually the research papers, but you can kind of understand them, and use AI, it's very helpful for those things. And try to implement something, write some code, write some simulation, see how it's worked, you know, backtest it, just go and build.
Is there some community of people on Discord or whatever where you can discuss this kind of thing, or you're alone you're on your own?
I'm not really familiar. We are kind of trying to build a community at Raven. We will see how that goes, but there are for sure communities online that do this. But go read and build, just start. And the moment you start, you see what the issues are, and that will give you ideas. Okay, how do I solve this issue? And then you move forward and forward, and then you read more papers, and then you get more ideas and more ideas. Oh, I remember this was an issue, and this guy solved it like this, and you get good.
So it's a long journey. It's
Yeah, something I will add on here very quickly is that first a person should get educated on the financial instruments and how they differ from one another, because for example, it's very different trading options than trading futures, than trading spot, or combining different different strategies that involve all those in the same strategy. And if somebody learns how the market actually works, what every instrument does and what it offers for what it is purposeful, then it can just go deep the rabbit hole, as Dany pointed out, like finding a community, reading the papers, trying to find out strategies with those type of instruments, and just see for himself where it works.
do we have any questions? Yes.
I would say here that we don't look too far into the future. We take things step by step because there is a lot of inherent uncertainty in markets. So basically, windows of opportunity open up with every new technology. So you gotta know the essentials of how markets operate, how participants operate, what are the driving factors of price in general, because most people don't know how price actually moves. So I truly believe that whatever trading tech there is, there will still be people who try to guess the future by some type of instrument, by some type of technology. For me, I don't try to think that far ahead into the future because I always know that I'll have to adapt anyway.
Do we have time for another question?
Yes, we have time for one more question. So let me choose. So the question was, is leveraging the only way for trading?
Helps a lot. If you're winning, you win more, obviously. The bad things happen in the fat tails where you get liquidated. And this is, I mean, we mentioned a few times risk management. When you're using leverage, that's, you cannot go wrong. One step and you're out. But obviously using leverage on a successful, it's capital efficiency. If everybody else in the market is using leverage and you're not using leverage, you're not capital efficient, and it's very difficult to compete.
Let me tell you something about leverage that most people get very wrong. So leverage is something very beautiful if you know how it works. Because leverage doesn't increase risk necessarily. Because I'll give you an example. If we run a strategy on crypto futures, we can have a high risk-adjusted return profile of the strategy with 25% of the exposure of the capital of the principal. So basically, at any time, we have like 25% invested in the market, and due to the interoperability of crypto and with wallets and with the stacking of different products and services, we can utilize the other 75% in something else. So basically, we can control volatility, we can have exposure to certain right-tail events, certain very big increases in price, and at the same time, we can be in DeFi, and this is all thanks to leverage. And at the same time, have a very low risk profile. So basically, it doesn't mean that you always have to do the usual case where you have 100 units of capital and you open a position of 300 units, which is the most often case. So basically, you have to know what you're doing, and that's why I always am a proponent of people learning the instruments, because if you learn what leverage and margin actually is, you will know that it serves a certain purpose in certain situations where you can have a big advantage at.
Strong points, and really, really true. Now, to touch on a point on leverage, well, when a pair receives leverage, it means it's a trusted pair. It means it's more secure, and it means it generally has enough liquidity that it will not, get rugged. I mean, ideally, and nothing bad should happen to that. That's why it's allowed to gamble, to trade on these higher marks. The ones without leverage, these are the ones subjected to even more risks. Be it time risk until somebody, reverses the trend, or, just running with the liquidity. So, for those pairs which are more secure, leverage has been added so you can effectively benefit from them. So leverage should not be something to scare you. Of course, if you do it the crazy way, if you do 50x leverage, and you want to let it open for 3 days, maybe some bad news are coming, but if you want it for 3 minutes, you will make your money. If you want for a couple hours, 3x leverage. If you want, I don't know, maybe more, 2x. Just adapt it, but leverage is seen as a good way. It comes as a, as a green mark on the asset that you're trading.
It's true what you said. Leverage is a risk management tool. If instead of buying $10,000 of spot that can go to zero and you lose 10,000, you can leverage 10x, deposit just 1K. In the worst case, you lose your 1K, and that's also, it could be your stop loss, and yeah, people don't think about it.
Yeah, it's making it like the asymmetric market. Little stake, high returns. Yeah, and generally, crypto is the most asymmetric market there is. I mean, the gains have been colossal. No other market has seen something like that.
Another question, or?
We don't have time for questions. Thank you so much, guys.